All right, welcome back, ladies and gentlemen, investors, traders, Finom Group members, and our general YouTube audience. My name is Seth Golden, and this is Finom Group's latest weekly State of the Market. And this week, this is a great pleasure whenever we can have Finom Group members and fellow investors and traders join us co-hosting the weekly State of the Market. So I want to introduce our newest victim of the State of the Market, Cliff. Cliff, thank you personally. Thank you for joining State of the Market as my co-host this week, and help our audience, help our Finom Group members get to know you better. How did you come to know Finom Group?
Yeah, well, number one, pleasure to be here. And pretty wild. Seth and I were just talking about our families and kind of our path, and I actually tripped over Finom. I was coming out of a divorce 7-8 years ago, kind of hitting the restart button on my life financially. Opened up a brokerage account with like $5,000 after the dust had settled from the divorce. And funny enough, the first trade I'd ever made, I actually shorted 6 shares, just 6 shares of VXX. And at the time, you had to call the trade desk, reserve the share. I was so embarrassed to do it. My uncle had turned me onto this trade a few months after Volmageddon, which I didn't know what it was at that time, and he felt like it was a safe place for me to dip my toe into the water. I did it, shorted it. A couple weeks later, I wanted to take my profits. I didn't even know how to sell my short sales. He said, "Hey,
Right.
Take your profits." And I said, "Great, I'm going to sell them." He said, No, you have to buy them back." So very, very elementary. Had never traded before, just had company 401ks. And I jumped online, did some volatility searches and whatnot. And, Seth's name had come up, various YouTube clips you had up. And my uncle had told me about you. And through time, you had kind of evolved what you were doing and created this platform for all of us. And I don't know specifically when I linked up with Finom, but it was pretty early on when you got rolling. And it's been awesome. I mean, I've learned a ton. I've taken that little 5,000 account. It's roughly $100,000 account, and got married, and had some different things happen that were great. And it's 5 times larger than that now between myself and my wife. And the same disciplines that I used when I did that $180 trade, I do now with $3,000 trades and $5,000 trades, and a lot of the disciplines that the guys know here, men and women know here, the 0.5% positions, 1% positions.
Right.
And it's been wild. It's been a wild ride, and it's been so fun. I mean, it's a money-making venture, but the community and just the growth has been really cool to be a part of.
Awesome. Thank you for that walk. You say it so modestly and so kind of matter of fact, how much you've grown your account over the last several years, 2018 to 2022, but seems very much like you take to the disciplines where small position sizes, in and out trades, trading around long-term core holdings. Are these kind of the basic tenets of how you go about your investing style and trading style?
Yep, absolutely. I have some bombshells. I mean, I have some Palantirs.
Oh yeah, me too.
But it's been wild as you've learned. Like, you had to put your toe in the water as you're watching these, certain stocks skyrocket, and something like Canopy Growth. I mean, I bought it at 20, sold it at 50, bought it back at 20. It's a $3 stock now.
Right.
But a ton of scalps in between, making $5 here, $10 there, like small. It's not embarrassing, obviously, but people think I'm crazy sometimes when I'm sitting in a meeting and I buy something. As I'm leaving the meeting, I sell it and I made $10.
Yeah,
it's crazy how those add up over time. And I've taken that discipline. We kind of merged finances, and the accounts grew and rolled over some 401ks and different things. I've gotten away from buying certain things that I've learned my lessons on.
Mm-hmm.
But yeah, just the discipline, and it's really what we do here. I've just continued to rinse and repeat. I take a flyer here and there. I'll buy a call. I'll sell a put. I'll do some unique things where maybe it's a gamble. But I do it knowing that when I make those decisions, it's usually going to zero, or it's going to be a big win. And I know that. And I think that you have to take some swings through time. We have some members. I mean, there's a laundry list of them. That you see some of their scalps and some of their trades. I'm mind blowing. Aim High, I love watching them work. And
He's a
I've learned
quiet, silent killer when it comes to profits,
it's incredible. And one thing I've really learned from Aim High is I've taken some smaller positions, even on stocks like JP Morgan, Verizon.
Right.
Maybe I'll take a quarter position, but instead of holding for that percent win, I'll hold for a 3% win.
Pay
So
for
it might
lunch,
be
pay for gas in the car, pay for diapers,
Yep, and it undoes a lot of the bad decisions. And I have some stuff I'm sitting on that I'm gonna let it ride. I'm gonna see what happens. And I have other stocks. I mean, T-Mobile is a bad example. I did some tax loss harvesting last year. I love the stock. Bought it at 130, sold it at 100, and now it's a $150 stock, and they're kicking Verizon's butt, which
right. Yeah.
certainly, we're holding that bag. But it's funny. When I look at my loss on paper, and then I look at everything we've done over the last 2 or 3 years. It's not near as bad as what it looks like on paper.
Right. Right. Yeah. And a lot of what everybody's been forced to do this year is to mitigate their drawdowns. You're holding these longer term positions because they're probably good companies. They're blue chip stocks. It's a bear market. Nobody does well. Nothing really suffers, well in a bear market. And, whether they're tech, big tech companies like Apple or Microsoft with these balance sheets that are, just gorgeous, doesn't matter. The market treats them all the same in this kind of environment. But those are the stocks you want to hold on to, in my opinion, do some dollar cost averaging and just trade around the core. The market's going to give us these opportunities where we can, buy on really bad washed out breath, washed out sentiment. And we can, get a quick trade, if not on the day, by the end of the week, and really improve our dollar cost average on these long-term core holdings, where right now in 2022, the P&L statement doesn't look good. But when the market turns around, when earnings turn around, when sentiment turns around, all of a sudden, all that trading, scalping, intra-week and intra-month trading that you're doing compounds the returns that are, coming back into your portfolio. I see a lot of folks, they move to cash, they just sit on the sidelines, and then it becomes, I've got to make 2 smart decisions. I got to get out of it at the right time, but then I also got to get back in at the right time. And quite frankly, not too many people are that smart. And, for when it comes to the market, you don't have to be. What it really takes is just intestinal fortitude. And, this is a year that has tested, many an investor. And it's, weeded out a lot of the, novice traders, would-be investors, and kind of set the stage for a recovery process at some point in 2023 into 2024. And so all this year, manage cash wisely, don't look away, it's the same thing you probably remember me saying back in 2020, don't look away. There's an educational experience here. You want to keep your touch points with this market through thick and thin. You want to keep your touch points with the market. You want to gain, at the very least, the educational value from this experience. And this is going to be the longest, deepest bear market without a recession. And that in and of itself is quite interesting.
Yep. And to speak to your point on the don't look away, I think 2020 is a great example. I mean, I'm sure there's a lot of members that, there were times where I was ready to throw the towel in, especially when I talked about my smallish account that, I think it went from $5,000 to 50 something grand. And then it was $24,000 at the low of COVID. And I'm working my butt off, various jobs, thinking, is this work? Like, why am I doing this? And just hung in there. And then next thing you know, that 25's pushing 100K. And I couldn't point to how it happened specifically. It was a mix of core holdings and dipping your toe in the water and scalps. And, I just think if you look at a chart of, any of our volatility ETNs, when they're at their highs 10 years ago to where they landed, the inevitable place, and then vice versa on an S&P chart, you just got to kind of keep the faith and, again, refine what you're doing. And you know this. I mean, you traded, from what it seems like to us, a smaller basket of stocks than a lot of what we post on Telegram and whatnot. Right. If you just have that patience and a strategy that's defined, you're going to do well eventually. You just need to hang in there long enough to do well. Yeah,
you got to stick with it. You got to stick with it. That when you said, Cliff, I don't know specifically, what one thing helped me get from 25, back to 50 and eventually 100. We do know one, very clear thing that got you there, and that was sticking with it, not giving up. As long as you're in instruments that have inevitability, which VIX exchange traded products do have an inevitable destination, or the market itself has an inevitable destination. It's just a matter of time. It's just a matter of time. And the more that you stick with the market, the better your results will be, once the market gets its sea legs underneath itself again. And it, we don't know exactly when that'll be, but we know it will come to pass. All right, quick look here, folks. This is where we are in the market today. We've been down 6 days in a row here, folks, which is very rare. The good news, though, is the last 11 times the market has been down 6 days in a row. The 7th day, the market was up every time. So we're in keeping with history here at the moment. So that's the good news. We'll see if we can, finish the day in positive territory. Our state of the market, which we record on Thursday, doesn't have a very good track record so far as its influence on the market. The worst trading day of the year for 2022 has been Thursday. Thursday has been red more than any other day here in 2022. So, all right, with that, we are going to jump into some of our notes here and our analytics for this week's state of the market. As you can see, everybody thinks they know what's coming next. Everybody is telling you a recession is inevitable. It's going to happen in Q1, Q2, second half of next year, but it's going to happen. And everybody is as confident about that as they are anything else when it comes to the economy and the market. But the reality is there are so many forecasts, and there have been so many prognostications this year that have already failed. So when I found this quote from Socrates, I felt it was so poignant here. Nobody knows anything, but I, knowing nothing, am the smartest man in the world. I just thought it was so telling for the time period. Earlier this week, Howard Marks, world famous investor, Howard Marks of Oak Tree Capital. He writes the Howard Marks, or the Oak Tree Capital newsletter. It's usually once a month. This year, he's done more than he's ever done before. But in the latest newsletter, I've extrapolated this passage. I'll read it really as quickly as I can. In the illusion of knowledge, I rallied against macro forecasting, which in our profession mostly concerns the next year or two. And in I Beg to Differ, I discussed the questions I was asked most frequently at Oak Tree's June 21st conference in London. How bad will inflation get? How much will the Fed raise interest rates to fight it? Will those increases cause a recession? How bad and for how long? The bottom line, I told these attendees, was that these things all relate to the short term. And this is what I know about the short term. Most investors can't do a superior job of predicting short-term phenomena like these. Thus, they shouldn't put much stock in opinions on these subjects. They're unlikely to make major changes in their portfolios in response to these opinions anyway. The changes they do make are unlikely to be consistently right. Thus, these aren't things that matter. And that was the title of this latest memo from Howard Marks, was the things that matter versus the things that don't matter. And Howard Marks just doesn't believe that investors should spend significant portions of time on the macro fundamentals or the big, economic picture. One of the reasons, these bullet points here are the reasons why, mainly because just because we think we know something or we think we, can see what's coming, it doesn't necessarily mean that there's anything to do with our portfolio. Secondly, more often than not, when we make these kind of short-term predictions, they're not right. And trying to be consistently right is even that much more of an arduous task. This year alone, we've been told oil was going to $150 a barrel. China was never going to reopen until, of course, it did. COVID would destroy the service sector until, of course, it didn't. Employment would never come back until, of course, it did. And so when we hear all these things that the market will continue to go down, I have to say, yeah, until it doesn't. And I don't need to know where the bottom is. I just need to know how much capital I have and how well I'm managing that capital, during this downtrend. So everybody proposes to know everything, but it just seems like when the boat is always tipped to one side, the market likes to make a fool out of as many people as possible. Go ahead, Cliff. I'm sorry.
Yeah, well, just listening to you reminds me of I think it was one of your quotes. I think it was from an old weekly research report. It's not what we don't know that'll get us in trouble. It's what we know for sure that'll get us in trouble. Yep. And that speaks to a lot of that. And then I did think of a question as you were going through this, and I don't want to get you off topic, but tax loss harvesting this time of year can sometimes play into this. I think I told my little T-Mobile story about how that was a big loss for me. Yep. Big picture when I was trying to get a write-off. How do you approach the tax loss harvesting thing? Because every financial planner I've ever met in an office, they lead with tax loss harvesting as their reason to use them. We don't talk about that much at Finom. How do you handle that?
Well, I generally go through a process of quarterly rebalancing in the portfolio. And within that process, there's an evaluation or an analysis done for each position, each investment vehicle in the portfolio. If I just don't feel that the investment vehicle is going to carry me toward achieving the investment objective, and I am suffering a loss on it, I will generally go ahead and use that for tax loss harvesting. It doesn't matter what time of year it is. Yep. It really comes down to a process for me. And the process centers on quarterly rebalancing, quarterly analysis, and evaluation of all the positions in my portfolio.
Got it.
So yeah, I try not to make it too cumbersome. And to your point earlier, so far as, I don't invest in a ton of different stocks or a ton of different ETFs. I try to run a streamlined portfolio so that I can, this process that I've, basically adopted and tried to perfect over the last, I would say, 5 to 7 years, allows me to do quarterly rebalancing, allows me to do this evaluation. See, a lot of investors will have upwards of 20, 30, 40 positions in a portfolio, and trying to understand the fundamentals, of 30, 40 stocks. I just don't think that there's time to do that. And if you don't have time to do that, more than likely you don't have time to dedicate to a successful process. That's just always been that's been my experience, as I've refined how I invest over, my 22-year career.
Yeah, I feel like I'm feeling that a lot more this year in a good way. Whereas last year I had, again, a ton of stocks. I wanted my toe in everything. Whereas this year I've got a handful that have carried over, the Palantirs, the Canopy Growths, some oddball ones. But the core 12 stocks that I kind of trade, Visa, Danaher, Apple, Amazon, I really haven't had any decisions to make this year because, refining the process I've gone through the last 4 years, being in my 4th year, there's really nothing to think about this year, which has been pretty wild outside of that occasional spec or two. Do I keep holding on, or again, do I let it ride as that lottery ticket or let it go to zero? So it's been interesting, the decisions that have changed for me, doing more Phenom-like trading than what I did when I caught myself in that middle of the road. I had a little more money to throw around, a little more aggressive. I haven't put myself in that situation this year where I have tough decisions to make.
Yeah, I mean, bull markets, everybody looks like a genius. You throw money at pretty much anything and it goes up. In bear markets, the cream rises to the top, and those who were reliant on the luck or the trend in the market are forced to realize that that is all it was. It was a lot of luck as opposed to skill. In a bear market, you realize where your shortcomings are as an investor or trader. And it gives you, and that's the whole point of, me suggesting that, this is really the best education for an investor. The bear market is the best education because you learn so much about who you are as an investor or trader. The market forces you, to understand your skill set, where your shortcomings are, so that you can, basically develop those shortcomings to where they're attributes and they become, well-defined skills within your, your tool belt of investing, if you will. So absolutely. And here's just, a screenshot from a Bloomberg order. As I said earlier, we were told, throughout the course of this year, China wasn't going to reopen. China wasn't going to reopen. And over the last couple of weeks, we have a full-on reopen now in China. And maybe it did take some of that civil unrest in China, those marches and those protests, for government and Xi Jinping to finally relent and open up and relax the COVID. The way that they've reopened, I don't know that COVID zero is even an appropriate terminology anymore, because in the past in China, the key element of COVID zero was all of that mass testing, but most importantly, you had to carry around with you a recent negative COVID test in your travels. Well, they no longer require that. So then how is it even COVID zero anymore? And we've seen, and what's so interesting about, what we've seen out of the China Hang Seng market, the Hang Seng market, as I think we spoke to it last week, was up some 25, 26%. And it's still going here in this month, which just emphasizes investors need to stay with the market, because something will catalyze that turnaround. You don't necessarily always know what it's going to be. But the market, the Hang Seng was up 25+% before the relaxation of the zero COVID policy. The market knows. The market knows. And we tend to like to second guess the market and wait for, a perfect signal, or, just we always, make excuses for why we'll wait for it to check back. Just, again, you don't have to make those decisions if you stay with the market, you manage cash wisely. You have a process where you rebalance your portfolio on a quarterly basis, so you know where you're comfortable so far as a cash position is concerned. And you're just in good standing as the year progresses. So, and don't get down, nobody should get down on themselves this year. Most fund managers do poorly. In fact, the only time, and we've spoken to this chart in front of us right here many a times in the past, the average portfolio manager, the average hedge fund manager underperforms the market every single year. The only time they generally don't underperform the market is during a down market year, because they just don't have a lot of market exposure. When you don't have a lot of market exposure during a down year, then the percentage, decrease in the portfolio is rather muted. But when the market turns around, also, you're going to see significant underperformance again, because these fund managers, they don't change their stripes. It's a business model. Fund managing, hedge funds and institutions, it's a business model, and the model is it's a fee generation business model. How do you keep your participants, the members in your fund, with their money? Don't show them big drawdowns. Well, the one way not to show big drawdowns is not to have a lot of capital exposed to the market at any one point in time. And as long as you're beating what they can get in their savings account, it's worth it to them. It's worth it. So this chart right here, this graphic, I should say, it never seems like a good time to buy. Never seen. Cliff, how would you characterize Finom Group's mentality when it comes to buying stocks? Just
I
generalize.
would, in general, it's always a good time to buy stocks. I mean,
I would, yeah, perfect. I couldn't.
we're not trying to catch bottoms. And those of us that have been around for a while, I used to, every time I buy something, I know it's going down another point or two. It's just the way it goes. And when I sell it, it normally ticks up a few. TJ Maxx has been a bugaboo, and I've made a ton of money off of it. But I've never caught the bottom, never caught the top. But we're in the soup, and we make our money and stick to our disciplines, and we don't overthink, so we don't get stressed.
Yeah, and one of the things that I've tried to preach for years is, and to your point, we're not trying to call bottoms, we're not trying to call tops. We're just looking for value. Is it cheaper today, and is it a good company? I follow the Warren Buffett philosophy. Maybe I bought high, but what I was buying is the company's fundamentals. And if they didn't change in the time that it dropped 1%, 2%, 5%, 10%, there was no material change to the long-term fundamentals. I'm just getting deeper value. And, I always practice the rule of 3 as well as, part of my investing and trading philosophy is, I assume going into every trade, I'm buying the top tick. And, that's kind of ingrained in my, approach is as long as I assume that and I build that into my layering strategy, I generally will do quite well because I'm giving myself a huge margin of error. I'm starting small and I'm building a bigger position if that deeper value, arrives. If the market makes me, it forces me to buy the same company value, the same company fundamentals at an even cheaper price, well, that never hurt Warren Buffett. Why should it hurt me? So, but this
Seth,
is.
I'm sorry. I was going to say, I would say we take advantage of headline risk probably better than anybody I know as well. I mean, we do a great job as a group, deciphering a headline and to what you said, understanding the root of what's going on, and in the flashy headline that triggered an algo or shook some people out. We typically know the basis of what happened to Apple, what happened to Amazon, what happened to, and we do very well in this group taking advantage of that headline risk.
Yeah, I guess I would thank, not it's not to my credit. It's everything that you guys share in in our trading group app, and what we discuss and in the trading room itself, the videos that we're watching, the educational videos and everything like that. It's just it goes back to another discipline that I've developed over the years and preached to is resources. Everybody needs resources. The lone wolf trader does very poorly. I don't think we ever see, a lone wolf trader on CNBC, having made billions of dollars, because that's just generally not how it works. In a room behind a screen by yourself without any feedback, without any, understanding of the regime and the trends in the market, it just doesn't lend well to a repeating profitable investing process. And so in this chart right here, what we have, it never seems like a good time to buy. Investors will talk themselves out of buying all the time. Here, the market is too high. I want to wait for a check back. Well, the market checks back. No, I convinced myself it's going to go even lower. Well, the market doesn't go lower. Then I'll wait for the next pullback. Now the market is really too high. Market checks back a little bit, waiting for things to set. We just make every excuse in the book at some point in time. I'll speak to a novice investor and trader. You can't manage risk that you don't take. You cannot manage risk you don't take. It's investing capital, invest it, buy. Then you start thinking in terms of how do I manage this position? Know what you're buying. That's the other thing. You have to know what you're buying. I'm not saying you have to know the technical trends, things like that, but you have to know the fundamentals of the company. How the fundamentals have trended over the last several years is always an even better purview. And that's for the majority of stocks in somebody's portfolio. when it comes to taking flyers or, taking a higher risk. There's nothing wrong with that either, as long as you understand the risk involved. But the bottom line is, whether you're taking a flyer or just buying something that you understand has good long-term fundamentals, you still have to buy. Like at some point in time, you got to buy. And, as you had mentioned, there's always a good reason to buy. You have to be willing and able to execute. I like buying value. I like buying pullbacks. And there's an old Wall Street colloquialism. Yeah, I don't like where people say, don't catch a falling knife. You're not going to know that you're catching a falling knife or not. That's just another reason to keep people on the sidelines. It's a colloquialism that really has no utility for sound investing principles. It's more of a fear-mongering tactic than it is anything else. This year, S&P 500 has spent most of its time below the 200-day moving average. It looks like the fourth longest period since 1990, below the 200-day moving average. We got above the 200-day moving average recently. We've talked, about that as being a signal, possibly of a new bull market, because historically, the 12 previous times where the market had been under its 200-day moving average for 150 days or more, like this year, once it got above the 200-day moving average, 6 and 12 months later, the market has been positive 92% of the time. And yeah, that's a number you want to lean into. It doesn't mean that you go out and buy everything the next minute. It means that you should be looking for higher prices over the next 6 and 12 months, not in a straight line, but higher than where we recently crossed above the 200-day moving average, which I think was like 40-30. I'm just using round numbers here, but it was around 40-30 on the S&P. So 6 months later, let's call it June, we should be above 40-30 if the higher probability plays out. And it's, does it look good today? I mean, the S&P just got above its 200-day moving average. Have the headlines gotten any better?
Negative.
Thank you.
Yeah, they have not. They have not.
Yeah, and all you hear is these doomsday scenarios. The recession is inevitable. It's all bad, bad, bad. But that's how it works. Like,
hey,
the
Seth,
market terms.
Sorry, I keep interrupting you. Bad
No
timing.
problem.
With that said, just because I don't want to lose the spot, the whole trader burnout and living this day to day and some of these things, obviously you're conditioned to where you handle everything that's thrown at you pretty well from what we see as members. Do you ever take a day, a week, a window of time to just shut it down and look away and just, I'm not making any moves, and not a pause like we did in COVID, not a strategic pause, but just a break to give yourself, a window of time not to think about all these moving pieces?
Only when I'm doing negotiations for the New York Yankees and we're signing Aaron Judge.
Congrats.
That's honestly, that's a great question. I want to say the right thing here, because I want people to, I always promote the art, education, discipline. And I would be of the opinion that it is a good discipline, to sometimes, just shut down the laptop, close the brokerage account, take a couple of days off, a week off. The market conditions are terrible. Just to decompress, gather your senses, and come back fresh, so to speak. I want to say that I practice that. I don't do it very much, but what I have found over the last, again, maybe 5 to 7 years, is that it is a necessary requirement for me. For me,
Yep.
It is. And so what I've done since I started this last year, because I do macro research reports during the week. I do the weekly state of the market during the week. I'm doing research every single day of the week, except for Saturday and Sunday. Saturdays, I'm writing the weekend research report. So what I found is I need a good month to do just that, decompress, kind of, evaluate the whole work-life balance situation. And work for me is investing. That is my work, as well as, doing all the research and content creation here for Finom Group. So last year I started where I took the month of December off, and I found that it was of great benefit to me. And I'm doing the same thing here this year. I'm taking the month of December off. I still do the weekly state of the markets, but we're not doing weekend research reports in the month of December. So it does give me a better work-life balance. It gives me something to look forward to also throughout the course of the year. And it does recharge my batteries. And sometimes you can, when you do have the time to step away, something pops up. Things allow themselves to filter through your head that you weren't thinking about during your daily routine. And I've noticed that. I recognized that last year in December, and I've already had a couple of things, pop into my head here in the month of December that, I was not clued into, so far as what I'm doing, managing capital and investing. So, that's my long-winded answer there. Hopefully it's, a little bit helpful.
Yeah, it answered it. Yeah.
Okay.
I find when I step away sometimes you do more when you do less. Sometimes you just need that break too, to let your portfolio kind of shake out and not overthink those scalps, or,
Right.
just give your stocks, those core stocks, sometimes to bop around where you're not trying to, is today the day I add another layer? It's worked out well for me. And it's hard because, like yourself, probably I'm OCD, type A, all those things.
Yeah.
So there is the FOMO, and it's not even FOMO of the money you're missing out on the scalps. It's the action.
Yeah.
But it has been a healthy practice for myself to just, I haven't been able to take a month off, but to take a Thursday, Friday and say, I'm not looking at the phone. I'm just going to work. I'm going to hold the kiddo, and the phone's on the charger, and I'm not checking what the market's doing. And it's Sports Center instead of CNBC. And it's worked out well for me. And usually my account does better when I do less.
There you go. Yeah, it's a good point. I mean, you hear a lot of, I think another famous Warren Buffett investing doctrine is, or I forget who it was, but he said something to the degree of, the one thing that gets in the way of investing is the market. Because there is an action, there's a gravitational pull, a human connection that we, because there's the lure, the carrot out there of, profitable return. So it's hard to do for a lot of folks, especially type A, high energy, highly motivated people. But yeah, if you can do, as you're saying, step away on a Thursday, Friday, and you've got all the incentive in the world with a baby now. So
I do and I don't.
yeah, I hear you. Nothing about a stinky diaper that's attractive, but you know what I mean?
Right.
All right, let's a couple of some quantitative data that we've been discussing, and we'll reiterate here this week. A key breadth thrust, or kind of a character change in the market, has occurred from October and November, basically off of the October 13th lows into and through November. We have what Steve Depp calls the 2 in 10. And that's basically 2 months with a 10% or greater return. And it's happened 12 times, going all the way back to 1970 there. Last occurrence in November of this year. And the key point I'll emphasize once again is, after this character change in the market, that's kind of how I want to characterize it, because that is a shift in character that we didn't have just kind of a 1 month, flurry. It was a good 45 days. It was a month and a half. But over that 2 month period, we gained 14.4%. Every time that this has happened, this 2 in 10, if you will, 6 months later, the market was higher. 8 months later, the market was higher. 12 months later, the market was higher. That's 100%. It's a good sample size at 12 occurrences. Now, looking at this another way, you could say that we gained back-to-back months of 5% or greater in back-to-back months. And this study of that kind of bi-monthly performance, if you will, or consecutive monthly performance, going all the way back to 1954. I'm using the Trader's Almanac, which is a fantastic resource. Here's the link, folks. But we've gained 5% or greater in back-to-back months. Every time that's happened, well, you do see some red on the screen 1 month later, i.e. consolidation, right? I mean, we've had a big move. This, what we're experiencing in the early days of December, may just be consolidation. And typically you do have a weak start to December, but things pick up around the midway point in December. Nonetheless, if we go out 6 months later, only one time was the market down. You had to go all the way back to, that looks like 1986. 1 year later, there's no red on the screen, folks. So whether it's a 2 and 10 or back-to-back months of 5% plus gains, the market has been higher every time a year later. And here's kind of a graphic, after that back-to-back 5% gain. Yeah, most of the time you do consolidate come the new month. But because of that significant change in market character, that consolidation usually, because this is the average performance, usually results in higher prices. So we'll see if that comes to fruition this time. We are getting consolidation early. So we'll see if we can get, after this consolidation box here, some liftoff as the month progresses. Now, here's another new interesting study from the Sentiment Trader. More than 50% of stocks are in uptrends. How do we characterize an uptrend? Well, get above the 200-day moving average. That's an uptrend. So the percentage of NYSE stocks above their 200-day moving average breached 50% after being at 10% or less recently. And that's, again, pretty significant change in character for the market. Have we done that this year already? Yes, we have. Did it blow up in our faces? Yes, it did. But that happened earlier this year in August. We're still talking about a narrow window of time. It happened in August. It's happening again here in November into December here. But historically, every single time, this is the occurrences or returns a year later. This has happened a lot of times, folks, where we've cycled from basically 10% or fewer stocks trading above their 200-day moving average to 50% or better. Every single time it's happened historically, these are all positive signs a year later. Not only are they all positive signs, only one of them was less than a double-digit gain. Only one of them. So there's 3 breath thrusts, folks, that look pretty powerful, compelling so far as the long-term possibilities. I use a different chart to basically show the same thing. This is my chart, same thing as the Sentiment Trader, but it gives you just kind of it's more granular. So as you can see, we got above that 50% line. We've checked back a little bit since, but we were also below 15%. Every time this has happened historically, the bottom has been in. That's what I'm really circling here. The bottom was in the market. Here in 2009 or late 2008, the bottom was in. Here in 2011, we had a good correction, 19%, the bottom was in. Here in 2015 into 2016, the bottom was in. Again, in late 2018, we went below 15%, then above 50%. The bottom was in late 2018, and we just did that again here. I take it back. August, we did not get 50% above. In August, we did not. It was only just now here in November. So this is actually a more established uptrend, if you will. A year later, positive every single time. All right. So we're heading into next week. We've got the Fed meeting, and we've got CPI next week, which I'm sure you know, Cliff, because that's all we hear about this year. And we know we're going to get a 50 basis point hike. That's kind of baked into the cake. The market has priced it. But I'm thinking if CPI delivers continued disinflation, we also have PPI tomorrow, by the way. I think that's going to show continued disinflation. There's a increasing probability that this could be the last rate hike. And I want to speak a little bit more in detail to this outlook, if you will. I'm not saying that this is going to happen, but this is my framework right now. Look, if we're getting this continued disinflation, and the peak is now 6 months in the rearview mirror, and we know that this disinflation that we've been seeing in CPI and PPI is still without owner's equivalent rent coming down year over year or month over month, shelter coming down year over year or month over month. Eventually, those are going to seep into the data, and we're going to have a bigger disinflationary CPI and PPI print. So that's why I say there's an increasing probability that this could be the last rate hike. Remember that there's no January meeting, right? So we're going to also have a December CPI that comes in January without, an FOMC meeting. The next FOMC meeting after this one is not till February. And if you can imagine that the disinflationary prints keep coming, why would the Fed not use it to its advantage to pause and to see if this trend just continues as 2023 progresses? And if that does actually materialize, the Fed pauses, right? A pause is not a pivot, they say, and quite frankly, depends on who you ask. But if it's just a pause, this chart right here shows every time the Fed has paused, going back to 1983, how has the S&P 500 performed once the Fed hits the pause button? From 1984 to 1987, where Fed rate hikes were on hold, market gained 104%. 1988 to 1990, 39%, 94 to 98, so on. And so the worst return was 28% from 2006 to 2007 when they hit the pause button. We don't need them to cut rates because that's all you hear. Well, the market doesn't bottom until the Fed starts cutting rates. That's also a very small sample size. Generally, the Fed has only cut rates maybe 5 or 6 times going back to the 1970s. And the lag times are all over the place. But this is definitive. When the Fed pauses and they don't need to cut rates, it's usually because they've engineered a soft landing or because the economy just continues to expand. So what's the need to cut rates? If anything, the Fed is actually looking to raise rates in the future, assuming the economy reaccelerates. So it's important to recognize the difference between a pause, a pivot, rate cuts possibly. All we need them to do is hit the pause button based on history. What do you think?
Well, for my business, I mean, I'd love to see a, what's that, 94 to 98 like scenario, but
Yeah.
for the here and now, I'm in real estate development and excavation. So, every print is big to us. We deal with D.R. Horton, NBR, a lot of the big track builders throughout the country. And every week I'm on a conference call with the city of Columbus, city of Nashville, city of Pittsburgh. And there's a lot of deals. No one's taking their foot off the gas in terms of what they do, but there is a lot of wait and see, a lot of deals that we have that are tabled just based on it's been tough to pencil out what it costs to develop a plan based on all this volatility and pricing.
Right.
A lot of optimism out there. And I mean, I'm anxious, non-stock related, to see how this shakes out and where we land over the next, 4 to 8 weeks.
Absolutely. Yep. Here's the average return. The average 1-year return after the final Fed hike is 14% for the S&P 500. It's a 12-month return, because these are, over periods of time, because the Fed may pause for a couple of years. But the average 1-year return is 14%. Now, here's the thing, like, don't dismiss this, folks. Everybody knows I've been kind of dour on the energy sector. Basically, since mid-year, I've been saying, look, you've had your fun. You've had your commodities boom. Your commodities boom is just about over, if not over. The worst performing sector after the Fed stops hiking rates is energy. Keep that in mind also, folks. The headwinds, they just continue to mount for the energy sector. It's not just the price deflation in natural gas and crude oil, in RBOB, et cetera, et cetera. It's the fact that if the Fed is able to engineer a soft landing or just pause for a period of time to see how things settle out, liquidity gets pushed in the market, risk appetite increases, and there's nothing really, that's altogether appetizing about energy sector stocks in that environment. You want growth. That's just not energy. It's just not energy, folks. So do keep this chart handy concerning Fed pauses. Here's the other thing that you hear all the time, right? The Fed has never, The Fed has never hiked rates into a slowdown, which is just completely untrue. It's completely untrue. The Federal Reserve has never hiked into a slowdown. 1978 to 1979, GDP slowed from 5.5% to 3.2%. The Fed hiked from 7% to 15.5% over that time period. 1994 to 95, GDP slowed from 4% to 2.7%. The Fed hiked from 3% to 6%. While growth was slowing, 2004 to 2006, growth slowed from 3.9% to 2.2%, and the Fed hiked from 1% to 5.25%. So much of what we hear out there is just utter nonsense. And, that's what I try to do here, with our weekly research reports, with our it's debunk a lot of the financial media garbage. I hate to say it, but that's how it is sometimes.
Hey, Seth, the chart a couple up from here when you were looking at the sectors that do well, I want to say it was sometime around this year, last year. I think you were trading KB Homes or one of the home builders. We did a handful of trades there.
Yes.
Are any of them on your radar currently, given kind of where things sit, or too much uncertainty still in that space for you to dip your toe in the water?
There is too much uncertainty there for me as a fundamentalist.
Yep.
But if you look at the home builders index ETF, I may have already missed the boat.
Yeah.
That sucker's, all we see, to my point earlier, we got above the 200-day moving average. Have the headlines gotten any better? No. What do we hear from the housing sector data basically since June? It's just worse and worse and worse. And yet, if you look at the XHB, I'm so glad. Great question. Let's pull that up. The XHB is the home builders ETF, 1-year chart here. And, bottomed back here in June. It almost double bottomed. But the S&P 500 has made a lower low. That's not the case with the home builders ETF. It's a good 10% off of its low. That's why I say I may have missed the move. Yep. But with the fundamental, backdrop being what it is, I may just have to live with that and say, it's not for me. I'll wait for, maybe just a better opportunity. And until, that becomes more clear to me, I'm okay missing it. Like, I'm not going to catch everything. As investors, we're not going to catch everything. So we stay in our wheelhouse, so to speak, All right. Good question, though. Thank you. And a lot of what we're hearing from the financial media is what I believe to be just the wrong questions. After the last, Powell's speech, what was it? The Brookings Institute webcast. The question that most people kept highlighting was, what did Powell say that was so dovish? I just think that was the wrong question. The right question, in my opinion, was, did Powell's speech breed more certainty on the terminal Fed fund rate? Right? We gotta we really have to kind of tune out because the financial media it's just a lot of noise. We've got to decipher things, absent the financial media a lot of times. And I think, within our Telegram group, within our weekly research reports and state of the markets, we do a good job of, context, putting context around why the market is doing what it's doing, as you alluded to earlier. Okay, so speaking about the Fed, kind of wrap things up here because we are getting long in the tooth, but I do encourage all of our readers, got a lot more information here, folks. For our Finom group members, comb through all the charts and the bullet points at your leisure here this week, because there's a lot of really good information, and I'll try to cycle through it really quickly as we wrap up. Fed tightening cycles from 1965 to 2022. This chart is past yield curve inversions, right? Because we've got the steepest yield curve inversion. And I'm speaking to the 10-year minus the 3-month. This is the steepest one since, I think, 1980, right? So it must be bad. It must be, forecasting a recession is imminent. That's all we hear. So in that sense, we also hear, well, the market has never bottomed before a recession. Right. And if we haven't had the recession yet, and if the yield curve is as steep as it is, it's pointing to an imminent recession. That's why you have all of these strategists and analysts saying the bottom's not in, because we've never bottomed before the recession. We've bottomed during the recession and before the recession ends, but never before. But here's kind of this nuance. I've pointed to the fact that we've never had a 28% bear market before a recession either. So what's priced in? We don't know in real time what's priced in. With this chart here, it shows all the past times in the market's performance 1 year after the 10-year and 3-month and 2 years after. So they color code it. 1 year back in 1966, 1 year return was 30%. The 2-year return was 9%. 1969, different story. A year later, market was down. 2 years later, it was up 26%. 1973, market was down. After the inversion, a year later, market was down. 2 years later, up 16%. 1978 occurrence, 1980 occurrence, 1989, 2000, 2006, 2019, and the average 1 year return after the inversion is 6%. The 2 year return average is 13.9%. But here's the thing. These are the plotted points for all of these dates where the yield curve inverted. This one right here, 1966, 1970, market was, basically still peaking. 1974, market was just off of its high. 1978, market had already corrected. The correction happens before the inversion. 1980, market was still rising. Then you had the big correction. 1990, market still rising. Really wasn't any material move in the market. 2002, market still rising. Big correction after the inversion. Market still rising. 2006. It took 2 years, but big bear market. 2018, it happened, well, I should say 2019, the market already corrected in 2018. The point is, the market corrected, when the market has corrected, before the inversion, the returns have been positive 1 year and 2 years later. It's only when the market was rising or at its peak that a correction came after the inversion. In each of the occasions where there was a pre-inversion correction in equities, the S&P 500 performed well in the aftermath of the inversion. Following the 1966, 78, 89, and 2000 inversions, The S&P 500 was healthy for the next couple of years. That's the nuance. Most of the inversions where there was a material correction after, it's because there was not a correction before. And so, that's how you tie these together. And that's why I asked the question earlier, what's not already priced in? How are we supposed to say a 28% correction from peak to trough does not account for some degree of that inversion leading to a potential recession? And here's that chart we've referenced in the past. Never before have we had a 25%. Right? This is closing basis. We've 28% on an intraday basis. Every other one, the next closest was 18%. The next closest before a recession actually started. Here's the other thing, the chart I kind of tweeted out today. The S&P 500 has never experienced a decline this deep, 28%, with the unemployment rate below 4%. Never. I mean, is it not safe to say the market is priced in a lot of bad things in the future? I mean, if everybody's expecting the unemployment rate to rise above 4%, we've never had a correction of 28% before that happened. Isn't it pricing in some bad things ahead? And we don't know the path next year. Everybody's calling. It's kind of consensus now that Q1 is going to have a big dip after the earnings outlook for 2023, right? Because all the companies are going to give their guidance for the full year in 2023, and earnings should come down on a year-over-year basis. We don't know by how much, but they should come down. And most people anticipate that's when the next leg of the bear market will finalize or conclude with a lower low. None of that's guaranteed because we don't know the degree of year-over-year earnings decline. We'll know better come the first quarter. But we don't know that it hasn't been accounted for already. We don't know that a recession is going to materialize, how long it'll be, or how deep it'll be. And these are all the questions that, investors want to know the answers to, but in reality, we're never going to have guarantees. So with that, that's all I've got this week. Again, folks, make sure you read through all of the charts and studies that we have here in the weekly State of the Market. Cliff, do you have any final words for us or any additional questions maybe?
No more questions. I think I texted you this yesterday. I read a quote the other day that said, if you want to go fast, go alone. I would argue in our space, if you want to go fast, that'll be trading yourself out of the market.
Yep.
If you want to go far, go together. And not just promoting Finom, but you've got to find a team, whether it's here or somewhere, to do what we do for a window of time that's going to, give you the runway that it takes to be successful. And I'm super appreciative of the entire group here at Telegram, or Finom, and on Telegram, the 10 to 20 people that actively post. It is greatly appreciated. Having a full-time job, having kiddos, I couldn't do what I do without obviously you, Seth, but the support, support of group members as well. I really trust a lot of what gets posted there, and I make a lot of decisions based on it that work in my favor.
Well, thank you for that vote of confidence and your participation. And, this was an interview from Jeff Bezos had the opportunity to interview Warren Buffett. And one of the questions he asked Warren Buffett was, you've done so well for many decades. Why don't people do what you do? And his simple answer was, nobody wants to get rich slow.
Yep. That's beautiful.
Want to go fast? Go alone. Yep. All right, brother. Thank you. Thank you so much for co-hosting with me this week. Thank you to our audience. And we'll be back next week with our, and we'll see how the market performs. We'll see if this was just consolidation and where we land come next Thursday. Enjoy and safe trading, everybody.